Who doesn't love it when risky plays pay off and make investors millions in return? Since you liked our previous video about that, we've decided to make this into a series where we look in detail at risky and unusual plays that you may have never heard of before. We'll see why they paid off so well and how you could replicate them yourself. Today, we're looking at two particularly profitable plays, one worth $70 million. So stay tuned and welcome back to PST Markets. Don't forget to like the video and subscribe for more videos like this one. Who could ever forget the GameStop short squeeze saga that happened 3 years ago? Well, it looks like GameStop is not yet out of surprises. One particular whale turned a $70,000 investment in GME into $1.28 million in just 2 days, banking a staggering 1,400% return. This was due to a sharp 2-day GME spike. Another whale, in a different context, mind-bogglingly made $70 million in just 1 month by investing in SPY stock. Were these traders just lucky gamblers, or did they see the spikes coming? And if they did, how can we replicate the move for future trades? Let's find out. From November 28th to November 29th, GameStop stock suddenly jumped from $12 to a 2-month high of around $17, a 28% gain in one single day. Right before that, a trader had targeted $20 call options, buying around $70,000, filled at $0.11. Following the GME spike, he exited the calls during the last hour on November 29th for an average of $1.71 per call, netting the whale around $1.28 million, a crazy 1,400% return. Well, for a few weeks, there were rumors that GameStop would have positive earnings. The Q3 report was set to be published on December 6, while the calls were set to expire on December 12. It's possible that the calls were bought in anticipation of a positive Q3 report, given how close the two dates are. With no other facts that could substantiate the rumors, this trade was, at best, a gamble. This is not crazy, given that Wall Street bets traders take highly risky bets with huge amounts and almost no information. The second scenario is still not based on much, but the whale might have wagered that the stock would go up and the trading volume would increase prior to the report anyway, given that GME stock ran during the lead-up to each of its last 3 earnings. A third scenario could be that at the time the whale made his move, GME's short interest was at 22.5%, which is around 60.67 million shares in this case. While 22.5% is admittedly not a very significant number, for perspective, short interest in GameStop was 141% at its peak in 2021. Around the time the whale bought his calls, Redditors on r/shortsqueeze were speculating that something would happen on the 28th. It's not crazy to think these Redditors used the 22.5% short interest as a pseudo-catalyst to cover a pump and dump scheme, which could be the real reason the stock went up. In the final scenario, and perhaps the most interesting one, it's also possible that the trader himself was actually part of a coordinated pump, or perhaps the one leading it. Of course, there's no proof of such a pump, and for good reason. It's highly illegal, but when has that stopped the apes? Overall, this is a risky trade, assuming that the whale really bet on the possibility of retail investors pumping GME before the report. The trader dumped $70,000 based on a prediction that a certain psychological pattern will continue. It's not crazy to think that the trader considered all of these combined scenarios and traded based on that. Nevertheless, the move highlights the importance of following trends and being involved in online communities for traders. After all, Wall Street was taken by storm in 2021 because Wall Street bets was a blind spot for them. In any case, a trade of this kind, though impressive, is by no means a very rare occurrence. Just 2 months prior to the GameStop spectacle, another whale made a staggering $70 million in a month by investing in SPY options. The story started back on May 15th, when a whale bought to open over SPY 47,000 calls averaged at $2.69 at a $422 premium, a total investment of $12 million. The expiration date was June 16th, roughly a month from the trade. The size of the trade, coupled with its close expiry, makes it very risky and unusual. So, how did things turn out for our whale? As you might expect, 3 weeks later, on June 9th, the whale exited the calls, which by then averaged $9.60, a 357% return. They sold for a total of $45 million, netting the lucky whale $33 million in the process. But this was only the beginning of an astounding series of profits. As soon as the whale closed the June 16th calls, he opened another 77,000 SPY contracts worth $1.65 on average, for a premium of $435 and a total value of $13 million. They were set to expire on June 23rd, just 2 weeks later. The contracts rallied 80% overnight, but the whale held until June 14th, when exited the calls for $4.01 on average and $36 million in total total value, making another $13 million in profit. At this point, the whale is on a roll, so he keeps going. Yet again, as soon as he closed the June 23rd calls, he bought another 38,000 calls at $4.01 for July 7th and closed them at $6.66 for a net profit of yet another $13 million literally overnight. The trader made an overall profit of $70 million over the span of a month. What could have clued him in on the spike in SPY? At the time he bought his first round of calls, SPY had been slowly going down from the height it had reached in August of the previous year. Yet just 1 month later, by the time the whale was on a streak of closing and opening calls, the stock had reached and even surpassed the one-year high by 5%. Were there any major indicators that this was going to happen? SPY isn't just a single company, so no particular earnings report or new acquisition deal is enough on its own to qualify as a good indicator. However, looking carefully at what happened, one particular indicator stands out. An important catalyst for the SPY spike was the debt ceiling deal Biden closed on June 1st. The stock began to return to its previous glory when it passed. You'd be wrong to think that this could have been predicted. Every year, the debt ceiling level is exceeded. Congress raises the level right away, but this year was different. Congress had been gridlocked for months concerning that deal, and there was no way to tell when or whether it would finally go through. So it came as a surprise for many that Republicans and Democrats finally agreed on closing the deal. A reasonable explanation for the whale's play, then, could be that they had insider information that the deal was going to pass. This suggests that the whale might be an important politician or someone involved in a powerful political circle, maybe a congressperson or one of their close relatives and friends. Insider trading is, of course, illegal, but when has this ever deterred politicians? In fact, the history of Congress members' involvement in trading is filled with alleged cases of insider trading. A recent example of these apparent cases is when House Republican Marjorie Taylor Greene invested in the energy sector in 2022, saying, "War and rumors of war are incredibly profitable and convenient." The invasion of Ukraine followed 2 days later. Another example is when Nancy and Paul Pelosi sold their shares in Nvidia just a month before the company was told to restrict its chip sales in China and Russia, which dropped its stock by 20%. Nancy Pelosi ignored the question when she was asked about the timing of her trade. It is therefore important to follow the trades by politicians such as Congress members, which they are legally required to disclose. Often, though, they disclose their moves very late, after the stock has moved far up or down, perhaps to avert suspicions of insider trading. But in case you find a seemingly mysterious trade by a politician before anything significant has happened, you should keep in mind that it's an indication that something big is on the horizon and plan accordingly. Even if they don't disclose the play, you should generally be on the lookout for trades with unusual volumes and timings, like the ones we've been examining. If you'd like to learn more about how you could do that, check out the other videos in this series, where I recommend simple yet powerful tools for monitoring the market. But don't forget, you should only try to make such a risky move if you have enough money to spare. High-risk plays could be an excellent part of an overall strategy that has some risky plays and a lot of others that are relatively safe. After all, no one got rich buying and holding Apple stock. Well, maybe Buffett, but you have to wait 30 years for that. Always remember that what appears to be insider trading could be the crazy gamble of some investors. And even for insiders, whatever they are expecting may not end up going through. Well, that's all for now. What do you think about these trades? Which one was more exciting? Were they too risky, or were they good moves? And finally, what could have caused the respective spikes in GME and SPY in the first place? We'd love to hear your thoughts in the comments down below. And if you enjoyed this video, don't forget to leave a like and subscribe to our channel to get more videos like this one. Your support helps us grow. See you in the next video.